Good afternoon, everyone. I'm Saraswati Raman and my matrix number is 255316. We are from Group 7, presented about Chapter 7, Treasury Instruments, and we are prepared for Sir Shahril bin Shafi, this is our video presentation and final report as well as. So in this chapter consists of 4 Treasury Instruments, and before that, this is the video Facebook link that we are provided to have everyone have a look and like and share this page. So in this treasury instruments, there consists of 4, which is interest bearing and discount instruments. Second, other money market instruments. Third, foreign exchange instruments, and the last is treasury derivative instruments. Okay, for the first instruments, interest bearing. This interest bearing is one of the securities that pay interest at a specified rate, either at periodic intervals or maturity. And these instruments are always issued in interest bearing form for certificates of deposits or bill of exchange. And next, instruments that may be issued in either interest bearing form or as a discount instruments include sterling commercial paper. For example, you can see here, assume a treasury bill with a face value 1000 and has a time maturity of 270 days, and current selling is $950. If the investor holds the treasury bills until it matures, they will earn a positive yield of, and this are equal to discount divided by face value first and then times with 360 divided by the time to maturity. So the final answer is the interest that got from the treasury bills is 0.0665%. And the next is discount instruments. In these discount instruments, right to receive a nominal amount which is face value at maturity, and then discount securities are sold at a lower price that is then lower than the principal amount received at maturity. The third is discount instruments derived from a discounting calculation of the future principal amount, which is treasury bills and certificates of deposit are one of the example for these discount instruments. So these are the example of discount instruments. First, calculate the value of a treasury bill. A nominal amount at maturity 1 million with 180 days to maturity, and a market interest rate is 20%. And if we calculated these discount instruments, we got $909,991 dollars. And second instrument is other money market instruments that consists of Jagamas bond, negotiable instrument of deposit NID, and the last is promissory notes. And here is the 3 other money market instruments definition. The first one is Jagamas bond, a debt instrument created by Jagamas Berhad, they're called as Jagamas, and the National Mortgage Corporation and leading securitization house in Malaysia. Jagamas is the second largest issuer of debt instruments after the government of Malaysia, and its debt securities have been rated AAA by RAM Rating Services Berhad and Malaysian Rating Corporation Berhad, the biggest asset-backed securities issuer in Malaysia. And for NID, definition is NID is a financial instrument issued by banks for the deposit of a specific sum of money for a fixed period of time at a prefixed interest rate. And it can be bought or sold before the date of maturity. A written instrument of unconditional promise signed by the maker or drawer. And next is negotiable instrument is a substitute for money or serves as an extension of credit. The last is types of NID are bill of exchange, check, and promissory notes. And for the promissory notes is a financial instrument with a written promise by one party, the notes issuer or maker, or to pay to another party, the notes payee. And this is the one of the earliest types of bills. It a promise to pay, and it should be contain the terms of the agreement to do so. And the last is a bank can issue a promissory note for anyone who is lending the money. Next, for those three instruments consist of their main purpose. For the Chagamas is debt securities to finance the purchase of housing loans and other consumer receivables from financial institutions, selected corporation and the government, provide mortgage in financiers with liquidity, and NID to avoid the carriage of higher amount of money and to reducing the risk of theft, robbery, transfer funds from one entity to the other entity, and promissory note form of debt that companies use to raise the money, legal lending document that says the borrower promised to prepay to the lender a certain amount of money in a certain time frame. The next is who and how it is created. For Chagamas bond, it created by Chagamas Berhad Chagamas, the National Mortgage Corporation, and NID is only a licensed banking institution can issue NID with the approval of the central bank. And promissory note is commonly written by banks like commercial banks, lenders, and attorneys. And the parties involved for the Chagamas bond is Chagamas company investors. For the NID, drawer, drawee, payee, or maker, acceptor, bearer, holder. Promissory note, drawer or maker or issuer. For drawee is known as payee beneficiary. The last is holder. The rights of each parties are for Chagamas bond is Chagamas company issuer, the authorization of all steps, terms and conditions to be taken and fulfilled in order to the company rights and fulfill its obligation under the warrant agreement. For the investor, rights in access the risk level and associated return to invest. Next, NID. NID's issuer only for liable person required, and those makers and acceptors are subject to primary liability. Uh, in For investor, the instrument become discharged by renouncers of the particular. The renunciation can be made by the surrendering or delivering the instrument to the primary liable. And promissory note, the rights of maker is a right to set off in action by a post-maturity transferee in an action upon a promissory note by a holder who was transferee after maturity. The maker sought to set off collateral claims which held against the holder's transferor, and and for the payee, in the event of a default, the right to disclosure of the maker's asset. Next, the responsibility or obligation of each parties. For Chagamas, the company issuer providing risk management tools for credit and portfolio. Other than that, facilitate strategy for resources management, conduct a reduction of systematic financial risk, lead management who is the Chagamas appointed financial institution to invite the investors to sign up for new primary market issues. For investors, they advise before subscription, purchase or acceptance of bonds to consult with their financial, legal and other relevant qualified consultants. While for NID, the drawer need to existence of the payee and his capacity to endorse, while to engage the presentment due, and the instrument will be accepted or paid or both according to its tenor. The maker should pay it according to its tenor and admits the existence of the payee and capacity to endorse. For the acceptor, the engagers should be paid in according to the tenor of his acceptance and admits by an existence of the drawer, his signature and capacity authority to draw the instrument, while the existence of the payee and his capacity to endorse. The responsibility for promissory note is maker need to pay the note according to its tenor and note holder capacity. It is secondary liability. The payee should be able to order the payable. The payee supply goods or services to the drawer. Drawer of the note make the payment to another person or company. Payee are flexible in designing who will receive the funds. Next is risk to each parties. For Chagamas bond, the company issuer consists of three risks, which is market risk, credit risk, and liquidity risk. In market risk is the loss of market interest rate as a result of adverse shift in the level of volatility. While for credit risk is the possible of uncertainty in sales arising from inability to satisfy the financial obligation of consumers or equivalents. Third is liquidity risk. Arise when Chagama's company may not have sufficient funds to meet its financial obligation. While for investor, the inflation risk is the dangers of inflation risk during the purchasing power of potential bond voucher loss and the principal. Why? And next risk is for NID instruments. The drawer will seek forged when during the signature of the drawer has been forged or signed by an agent who has no authority to do so. The drawer or maker will not be liable on the instrument. And material alteration, a negotiable instrument with scratches on it or which otherwise indicates an erasure or alteration cannot be enforced at all against the original drawer or maker. For drawee, the risk associated with negotiable instruments that might include restrictions placed on the transfer by one person or another. There might be a lack of funds being available when the instrument is used for payment. And for the promissory notes, it is unlike a contract. The promissory note does not need to be signed by both parties. It is essentially a promise from one party to the holder of some good or benefit. Promissory notes will generally be fully fungible, and these are modeled as a kind of contract but are essentially a kind of unilateral contract between the issuer and the holder. While some authorities might not see this as a contract at all, and cash is a kind of promissory note with the issuer being a central bank.
Good day everyone, my name is Gomati, daughter of Muniadi. My metric number is 255373. Now I would like to present the reward or benefit of each parties. First, for the Chagamas bond, Chagamas company issuer, the increased size of issue that meets the minimum size prerequisite to incorporate the Chagamas bond into the powerful. Next, for the investor benefit in the form of higher return other than the similarly ranking and maturity financial instrument. The availability and the credibility of the parties to the transaction of high quality securities depend on the underlying asset quality. A creative system will theoretically deliver greater returns with greater risk tolerance. Local currency index raises the weights of the Chagamas bond in the index. Next is for negotiable instrument of deposit. One of the biggest advantages of bill of exchange is that the consideration between the debtor and the creditor is pre-assumed. So we will assume that the purchaser is in debt of the seller. The seller need not prove this fact. Since the bill has been accepted by the debtor, the code will assume that such debt legitimately exists. The creditor does not have to wait for the maturity period to get the money. He can immediately opt for the bill discounting, or he can endorse the bill to a creditor of his, so his money does not get locked in. Accommodation bills enables the businessman to obtain funds at low rate of interest to meet any temporary financial shortfalls that may arise from the time in business. Next is promissory notes. The maker or payee flexibility in specify how the payment will be made. For example, in installment or in the future or on demand. You can avoid pledging your property as a collateral as you will with the secured promissory note. For the payee, it is possible for the payee to sell a promissory note unless the note specifies otherwise. Next is pricing mechanism. For the Chagamas bond, the company which is based on the Chagamas rate is based on the appropriate rate of the returns for the determination of the Chagamas installment. Chagamas rates depend on the bond yields and the market condition of Chagamas as the following. The trading formula of the Chagamas bond is proceeds equals to price over 100 times with the face value of the bond, plus with coupon rate times with the number of days from the last interest date to the settlement date divided by 36500. And this is one of the example to calculate the proceeds of the Chagamas bond. This is the pricing mechanism for negotiable instrument of deposit, which use a short-term negotiable instrument, and the calculation of proceeds as follow: nominal value 1 plus coupon interest rate times with number of days between issue date and the maturity, and divided with 36500. And this is for promissory notes. The amount received on the date of discounting is called the proceed, and in order to get the proceeds of the promissory note, we should minus the maturity value with the bank discount. Next is how the instrument is traded. First, for the Chagamas bond, Chagamas Mudaraba bond introduced by the Chagamas Berhad to finance the purchase of Islamic housing debt from the financial institution to provide Islamic housing financing to the public. This Mudaraba bond is structured using the concept of Mudaraba, where the bondholder and the Chagamas will share the profit according to the agreed profit sharing ratio. And this is the process of Chagamas Mudaraba bond. And for the negotiable instrument of deposit, the first step, the drawer will request the checks to the bank, and the bank will issue the check to the drawer. And the third step, the drawer will deliver the check to the payee, and the payee will present the check to the drawer's bank and receive payment from the bank. For the promissory note, first step, the drawer will issue and send the note to the bank, and the drawer's bank settlement of the dematerialized note as push payment, and the drawer's bank will inform the payee after crediting his account, and the drawer will supply the goods and services to the drawer, which is the customer. Next, is there any secondary market? First, for the Chagamas bond, yes, the Chagamas bond can be purchased from the primary or secondary market. New issues can be sold in the primary market. Investors can subscribe for new issues through the Chagamas or appointed lead managers. Existing Chagamas bond can be purchased from the secondary market. And for negotiable instrument of deposit, there is a secondary market. Trading of negotiable instrument deposit or Islamic negotiable instrument in the secondary market can be undertaken through the following transaction. First, outright sale and purchase. Second, repurchase and redemption. Number 3 is repurchase agreement. And for the promissory note, and there is a secondary market, the salespeople who market promissory note typically includes security brokers, insurance agent, financial planners, and investment advisors. Since the promissory notes are usually securities, they must be sold by the salespeople who have the appropriate securities license or registration, like Securities and Exchange Commission (SEC). Where and how can you have access to the instrument? For the Chagamas one, we can access at Commercial Bank, Malaysia Building Society Berhad, and the Development Financial Institution. However, for negotiable instrument of deposit, NID issued and traded in the Malaysian market can be based on either fixed, zero coupon, or floating rates, or combination of either the three. And for the promissory note, negotiable instrument of deposit or in the bill of exchange. Next, how does the instrument used in bank treasury operation? First, Chagamas bond. The treasury bank will administer the treasury management policy (TMP), which provide for the management of the exposure of the company to various treasury risks. Next, negotiable instrument deposit. We choose example of check. This is just another form of bill of exchange. Here, the drawer is the bank, and such a check is only payable on demand. It is basically the depositor instructing the bank to pay a certain amount of money to the payee or the bearer of the check. And for the promissory notes, when the bank receive a deposit of fund, either in Federal Reserve notes, cash, or some other forms of the promissory promise to pay, like a check or promissory note, they will open a demand deposit account or make deposit in an account already opened in the name of depositor. Next slide is, are there any official guidelines regulating this instrument? First, for the Chagamas bond, banking asset count for capital adequacy risk weight of 20% and the liquidity status of class 2. The liquefiable category 2 level is raised to 50% as part of liquidity process. Like other credit exposure, insurance company asset are known as a credit facilities and tend to granted the status of an acceptance, and primary issuance of the Chagamas debt securities will have the impact of market driven securities. Negotiable instrument of deposit regulated by the Bill of Exchange Act, regulated by the Reserve Bank of each countries and the Security Commission, with compliance at all circulars guidelines applicable to the all banking institution. And for the promissory notes, regulated by Bill of Exchange Act and the Reserve Bank of each countries and Security Commission with compliance at all circulars guidelines applicable to all banking institutions. Next slide is who are the regulating agencies for the Chagamas bond: Security Commission of Malaysia, BNM, and also Bursa Malaysia. And for the negotiable instrument of deposit, authorized depository like Commercial Bank and also Merchant Bank. And finally, for the promissory notes, NID, Bill of Exchange, authorized depository like Commercial Bank and Merchant Bank. That's all from me. Thank you.
Assalamualaikum and hi. So my name is Siti Nur Hijrah binti Basri and my matric number is 255878. Okay, so next part is about the foreign exchange. So I will brief with you what is foreign exchange market, and then we also can know why do we need to exchange one currency for others, and in this part also can brief about the functions of foreign exchange market, and we know the level of participants of foreign exchange, and then in this part also brief about the functions exchange rates, and we can know the effective exchange rate, and then um, foreign exchange risks and advantage or disadvantage of foreign exchange risk. Okay, what is foreign exchange market? Okay, the foreign exchange market is the market in which individuals, firms, and banks buy and sell foreign currency of foreign exchange. The foreign exchange market for any currency is comprised of all the locations where the currency is bought and sold for other currencies. These monetary centers are connected electronically and are in constant contact with one another. This forming a single international foreign exchange market. Okay, next, why do we need to exchange one currency for another? Okay, foreign exchange is the trading of different national currencies or units of account. It is important because the exchange rate the price of one currency in terms of another. Okay, it also can help to determine a nation's economic health and hence the well-being of all the people residing in it. Okay, the exchange rate is also important because it can help or hurt specific interests within a country. Means, exporters tend to be helped by a by a weak domestic currency because they will sell more abroad, while customers are hurt by a strong currency because imported goods will be more expensive for them. Okay, next, functions of foreign exchange of market. There are three functions. The first function is to transfer funds or purchasing power from one nation and currency to another through an electronic transfer or internet. And then the second function is credit functions. So credit is usually needed when goods are in transit and to allow the buyer some time to resell the goods and make the payment within 16 days or 90 days after sight. And the last function is to provide the facilities for hedging and speculations. Today, about 90% of foreign exchange trading reflects purely financial transactions, and only about 10% trade financing. Okay, next, level of participants foreign exchange. So there are four level of participants. So the first level is about the nation central bank, the seller or buyer of last resort interbank. And the second level is foreign exchange brokers, clearing houses between users and earners of foreign exchange. And the third level is commercial banks, immediate users, and supplier of foreign currency. And the fourth level is traditional user. So traditional users such as importer, exporter, investor, and so on. Okay, next, foreign exchange rate. So, in the foreign exchange rates, there are direct and indirect quote. So, direct means when the exchange rate is expressed as the home currency price of a unit of the foreign currency, and the indirect quote is if it expressed as the foreign currency price of unit of the domestic currency. Okay, then depreciations and appreciations. Okay, depreciations means an increase in the domestic price of the foreign currency, and appreciations is a decline in the domestic price of the foreign currency. Then cross exchange rate. So a cross rate is an exchange rate of two currency expressed in a third different currency, such as the exchange rate between the euro and the yuan expressed in yen. Okay, next, what is an effective exchange rate? Okay, some currency may appreciate and some other may depreciate. Then we need to calculate the effective exchange rate. So it is a weighted average of the exchange rates between the domestic currency and the nation's most important trade partners, with weight given by the relative importance of the nation's trade with each of these trade partners. Okay, next, there are three of foreign exchange risks, which is transaction risk, translation risk, and the academic risk. Okay, for transaction risk of change in the currency rates in the adverse directions from the date on entering the transaction to the date of settlement. And for translation risk is risk of movement in the consolidated financial position and earning resulting from exchange rates in system. And then economic risk is risk of change in the market forecast of the company's business and future cash flow resulting from a change in the exchange rate. Okay, next, advantage and disadvantage of foreign exchange risk. Okay, for advantage, first, foreign exchange fluctuation provides an opportunity of gaining from favorable movement in the currency of open foreign exchange positions. And second, availability of numerous new and innovative products to hedge the risk. And third, risk can be hedged by pairing the open positions in the currency with the same or precisely opposite foreign exchange movement. And fourth, the flexibility of hedging the risk is an exchange traded or an over-the-counter markets, as both the markets are very much liquid. And last, foreign exchange market operate around the clock in one or the other country. Hence, the hedging or speculation is possible anytime. Okay, then disadvantage of foreign exchange risk. Okay, um, the first disadvantage is it can result in huge losses even if there is small movement in the rates where the open when the open positions is huge. And then hedging risk involves an additional cost. Third, disadvantage, hedging result in margin requirements along with a change in the foreign exchange rates. And last, rate and spread determination is a complex process and is often opaque. Okay, that's all my part. Thank you.
Hi, Assalamualaikum. My name is Almaswani Shazwani binti Mustafa. So I want to proceed to the last section, which is derivatives instruments. This section, I want to focus to the future contract and option contracts. So we proceed. What is derivatives instrument? Derivatives are financial instruments used to manage one exposure to today's volatile market. A derivatives product's value depends upon and is derived from an underlying instrument such as commodities, interest rate, or stock. In other words, a derivative is a financial contract with a value linked to the expected future price movement of an underlying asset it is linked. It is used as a tool to hedging, speculating, and arbitraging. We proceed to the purpose of a derivative. The first one is to manage the price risk. The second one is to fluctuation in the price of physical commodities or financial instrument. The last one is to make a profit by correctly anticipating price change. Proceed to the participants in the Malaysian derivative. The Malaysian derivatives market is made up of diverse range of participants. There includes the regulator, derivatives exchange, clearing house, intermediaries, users, clients of the intermediaries. So we proceed to the type of instrument, which is forward, future, option, and swap. Forward is an agreement to buy or sell an asset at a predetermined price as a future dates. This is a highly customized derivative which is not traded on an exchange. Future, an agreement to buy or sell an asset at a predetermined price as of a future dates. This is a standardized agreement so that they can be more easily traded on a future exchange. The third one is option. Called option, an agreement that gives the holder the right but not the obligations to buy share, bonds, or commodities or other assets at a predetermined price within a predefined time period. Swap is an agreement to exchange one security for others with the intent of altering the security terms to which each party individually is subjected. That's the difference between further contract and forward contracts. For the further contracts, they are exchange traded, while for the forward contracts, they are over-the-counter agreement. Secondly, for the further contract, they are standardized contract specifications, while the forward contracts, they are customized contract. Thirdly, for the further contracts, the profit and losses market to market, while for the forward contract there are no mark to market. Fourthly, for the further contract, there are active secondary market, while for the forward contract there are no secondary market. Lastly, for the further contract, there are margin requirement, while for the forward contract there are no margin requirement. So we proceed to the difference between option contract and swap contract. For the option contracts, an option is a right but not an obligation to buy or sell a financial asset on specific date at a pre-agreement price. For the swap contract is an agreement between two parties to exchange financial instruments. Secondly, for the option contract, option can be bought or sold through an exchange or developed over the counter. While for the swap contracts, they are over-the-counter financial product. Lastly, for the option contract, there are a premium payment should be paid to acquire an options. While for the swap contract, swap do not involve premium payments. So next, what is a future contract and what is option contracts? So firstly, for the future contract is a standardized agreement made between two parties to buy or sell an underlying asset on a specific date in the future for a predetermined price. While for the option contract is a contract between two parties in which the buyer or seller has the right but not the obligation to buy or sell. a specified asset at a specified price at or before a specific date from the seller or to the buyer. We proceed to the advantage of future contract and the option contract. For the future contract, the investor can use future contract to speculate on the direction in the price of an underlying asset. The second one, company can hedge the price of their raw materials or product they sell to protect from the adverse price movement. The last one, if future contract may only require a deposit of a fractions of the contract amount with a broker. So we proceed to the option contract. Option seller can receive a premium fee from the buyer for writing an option. The second one, a call option buyer has the right to buy asset at a price that is lower than the market when the stock price is rising. The put option, buyer can profitably by selling stock at the strike price with stock price when the market price is below the strike price. So we proceed to the disadvantage of future contract and option contract. For the future contract, the disadvantage is investor have a risk that they can lose more than the initial margin amount since future are leveraged. The second one, investing in a future contract might cause a company that hedged to miss out on favorable price movement. Margin can be double-edged sword, meaning gains are amplified but so too are losses. So we proceed to the disadvantage of option contract. In a falling market, the put option seller may be forced to buy the asset at the higher strike price than they would normally pay in the market. The call option writer face infinite risk if the stock price rises significantly and they are forced to buy share at a high price. Lastly, option buyer must pay an upfront premium to the writer of the options. That's all from our group. Thanks for watching. Hope all of you can learn something from this video.